Uh, Thank you, Dr. Nikhil, for having me here. Dr. Nikhil was my senior at AIMS, and now he's a senior guide at WealthCon, and he's one person from whom I have learned during my JR-ship, and I continue to learn even at 50 now through WealthCon. Thank you, Dr. Nikhil, for having me here. Only thing is that this IC was actually not planned. They gave us this IC 1 week back. So we were all running around to whom to start, how to go about the presentations. So it's all put up together in a very small time. And I had my presentation about tax previously done in our state conference. He said that you have that, you do it. Only I thought it's okay, I can finish off this presentation, only to realize that Nirmala Sitharaman madam has changed so much in this budget that I had to do the whole thing sitting in the night yesterday. I had to do this presentation again to tweak the rates that were there, what all they changed. So I had to redo the whole presentation. So I'll tell you, first disclaimer is I'm not legally a financial consultant. So please consult your qualified financial advisor or a chartered accountant. Tax laws change and individual circumstances can impact your tax liability. So professional guidance is crucial. What we want to give you here is to understand the various terminologies that are there so that when you talk to your tax consultant, we should not be ignorant. We should ask the right questions to get the correct savings that we are entitled to. Otherwise, they do a very superficial work and will end up paying more taxes. They may show you some minimum tax saving, but you can actually save tax more. Now, how does tax impact us? So let us assume that you have to buy a laptop that costs 1 lakh and you pay a GST of 18%. So total cost is 1,18,000. So this is what we all thought. Okay, this is how we are thinking now. So I paid 1,18,000. If I have 1,18,000 in my bank account, I can buy this laptop. You are correct. But suppose you think that you had a gross salary of 30 lakhs. Now, first you have to pay income tax. Then after you paid the income tax, then you're left with the income in your bank. That is the real income that is left after tax. So if you spend 1.18 lakhs, then what is the effective cost, including how much you already paid for tax on that 1.18 to be there in your bank account? Okay? So to understand how it is, so the salary before tax is, this is the calculation, is 30 lakhs. So you paid 4.8 as income tax. So your take home is 25.2. Okay? So that is the net in your hands. So the effective tax rate for your 30 lakhs is 16%, total put together. So you remove all the tax slabs. So your effective tax is 16% you are paying to the government. If you earn 30, you are paying 16%. Okay? Now article cost is 1 lakh, 18% is the GST. So 18,000 is the GST amount that you paid. For that 1,18,000 to be present in your bank, you should first have earned 1,36,000. So the government takes away 36,880 rupees for a laptop worth 1 lakh. So this is the calculation that we have to think. That's how money is so important. That's what I wanted to get you involved in. So the government makes a cut of 36 or 37% if you are in a 30% tax bracket. Suppose you are more than that, you go to 50, this amount that is required is actually 1.45 per lakhs that would be required. So this is the calculation that we should think in mind. And when it comes to paying interest, that's why he said don't take loans. When it comes to paying interest, you think you're paying 8% interest. It's not actually 8% interest. 8% interest, for that 8 rupees to be in your bank, first you have to earn 8% plus 30% tax that you have to pay. So that is the total amount. So keep those things in your mind, back of your mind, whenever you're doing not the simple maths calculation. The real math is totally different. So the government makes a big buck on whatever we spend, okay? But however, if you are having a company, private limited, then this can be directly taken away as expenses, and you can also claim depreciation. Here it is totally different. If your company has made 1.8 lakhs and you are spending 1.18 lakhs on this laptop, there is no income tax involved there, unless you are earning a lot for the corporate taxes. But otherwise, this is taken directly as expense only. So there are various incomes that are taxable, all sources, legal sources of income. How are they taxed and how to save tax is what I'm trying to tell you in this. So you have two types of doctors amongst us. One is the salaried people, whether you're in private or government, or professional fees, those who take professional fees, working in self-employed clinic or private setups or freelancing. These are the two people. Now income from sources include from salary, income from house rent, income from capital gains, income from professional or business profession, or income from other sources. Suppose you are on a panel on a medical college and you also do freelancing, so you'll have a salary income and you'll also have professional income. So both things have to be taken into consideration. So whatever you do, tax from regular, that is the salary, professional, rental, or interest on deposits, and interest from investments, that is whatever you are doing as investments, or if you are going into very advanced income from futures or options. So you will have to go through this. Again, there are two things that you need to be understanding is the old tax regime and the new tax regime. Each one has its own advantages and disadvantages. So again, you need to talk to the tax consultant, ask them to calculate it and show the difference between the two, and then take a call. Otherwise, they may be just simply doing it under the new tax regime, but you ask them to show the calculation difference. Why it is important? That's because in the old tax regime, whatever we had, that these ATC, ATD, all those exemptions and deductions are available. Under the new tax regime, none of them are available. Okay, whatever you are doing, suppose you are doing, if you go into that, it will not available. However, the tax rates are different. So that's why you need to have a tax calculator. Again, you can go to the income tax website. They have the tax calculator there. Put up the things and compare yourself before you do the pay the tax. So this is the bird's eye view of all options available for tax deductions. I think Dr. Nikhil briefly told it. One thing is for the girl side, Sukanya Samriddhi account is one thing that is a very good investment. It is like a PPF in the name of the kid. And starting a business and efficient investment portfolio and filing returns timely is also very important. If you don't file your returns, then you lose many things. So that is also very important. File your returns, don't miss filing your returns. As far as your income from investment is concerned, so if you have a gain, again there are two types of gain. One is called as a short-term gain, other is called as a long-term gain. So what is short-term, what is long-term? Again, they have classified it for different asset classes. Previously, short-term gain was 15%. So now it is revised to 20%. Previously, long-term gain was 12.5% and above 1.25 lakhs. Suppose you have made an investment, like what Nikhil sir said, and you make a profit. First 1.25% of your, 1.25 lakhs of your profit is tax-free, provided you have held it for more than 1 year. Suppose you invested this year and next year, after 1 year you have sold. If you have made 1.25 lakhs, it is tax-free, first 1.25 in a long-term investment. However, you sell it 1 month before, that is at 11 months, then you will end up paying 20% of the what you have earned. So knowing these things are important. Although you made a profit, but you will end up paying more tax. Again, there is for the professionals, there's something called as a presumptive taxation. This comes under sections 40A, 44AD and ADA of the Income Tax Act. So this is people who are eligible for this is the professionals, and medical doctors can do it under this presumptive taxation. Here, the important thing is you don't have to maintain the book of accounts. Okay, so what you do is it is applicable to up to your 50 lakhs of earnings. And suppose majority of your earnings we were discussing previously is in digital way or through your bank account, it can go up till 75 lakhs. So if it is cash component of your business is less than 5%, then up to 75 lakhs you are eligible to use the presumptive tax. So what it means is, in the ITR, tax member may record 50% of that as taxable income. Suppose you earn 50 lakhs, 25 lakhs you should say is taxable, 50%. Otherwise, you have to pay or maintain book of accounts if you are not going under this thing. Okay. So I think for the accounting, it's 75 lakhs now. If you cross 75 lakhs, you need to keep an audit. Your account will be audited. Again, for small taxpayers, you can also have individual HUF and partnership. Here, up till 2 crores can be done under the presumptive taxation. So having an optical or pharma that is separate from your PAN would be beneficial. So you can file a separate PAN. You can have a PAN in the name of your family member or a HUF, Hindu Undivided Family, or a partnership. So you can have a different PAN so that you can take benefit of these taxes. Otherwise, if you club all the income to yourself, then you will not be eligible. So as I told you, you don't have to maintain the book of accounts, and you don't need to pay advance tax each year and can pay it in the last installment. Then what is meant by capital asset? Capital assets is owned by individuals that may or may not be connected to the business are called as capital assets. For example, real estate, bonds, equity, mutual funds, jewelry, patents, trademarks, all come under what is called as a capital asset. And profits or gains arising from transfer of this capital asset is called as capital gains. So whenever you sell this, whatever gain you make is called as capital gains. So any investment will go through these definitions, that is short-term gain or loss, long-term gain or loss, and FNO I will not touch, it's a higher thing. But again, if you are doing it intraday, that is called as speculative. There, the intraday profits are treated as speculative business income, while FNO we are doing is considered as a business income. So whenever you are calculating the tax, it will be based on what is how much you have made a profit minus what you spent when you acquired this asset, what you spent for cost of improvement, and the expenditure incurred wholly, exclusively in connection with this transfer. All of them can be subtracted from the gain you made. So this is legally available. So you just don't think that you had a 1 crore plot and you sold it for 1.5 crores, you made a profit of 50 lakhs. But these are all the things that you can reduce, you can use. Then there's something for long-term capitals, there's something called as indexation, indexed cost of capital. So what you bought in 2000 and you are selling in 2025, there is something called as indexed cost. I will show you that. So this is the short term and long term, okay, of the equity mutual funds. Less than 1 year is short term, anything more than 1 year will be long term. As told, the SGB, that is sovereign gold bond, is exempted at maturity, only if it is at maturity, not before that. Then something called as a grandfathering. How many have been doing mutual funds before 2018 here? Anybody who's been doing that? So if you have done a mutual fund before 2018, February 1st, and you want to sell it today and you had a profit, then there is a different way of calculating the profit. Suppose you had a 1 lakh and now today it is 1 lakh 50,000. So it is not 50,000 as profit. There's a different way to calculate it. So only those which are bought before 2018 can be applied for this, what is called as a grandfathering. To give an example, suppose you bought a share at 100 rupees and the share in 2000 January went to 125 rupees. This is taken as the FMV or the fair market value. And today in March 1st, the share is worth 150 rupees. Okay? So the long-term capital is not taken as 150. It is not taken as 50 rupees. It is taken as between January 31st, 2018 and the current rate, that is the March 1st rate. So this you should know. Otherwise, your CA will not, if he is not aware of these things or you don't ask him, he will just make you pay for the 50 rupees that you have made, when you actually have to pay for only 25 rupees. Because the fair market value as on 31st, because this income tax rules keep changing. So this rule was changed in 2018, how much you pay. So the government allowed that if you have bought something before this, then you are allowed. Same way with respect to indexation now. Previously for land, indexation was allowed. Now I'll show you the date. After that, whatever you purchase in 2024 onwards, it is not available for indexation. Now the same share I was discussing, it went to 125. Suppose in April now, because of the market crash, if it came down to 125 or 115, okay? Now you actually made a profit of 15 rupees. But you see that its fair market value was 125 rupees on 31st. So your tax is 0. So you don't have to pay a tax, although you have made a profit of 15 rupees. That is important, because it is below its fair market value as on 31st of January. So these things, Which one? No, loss you cannot. For loss, the government will not share. Only the profits will be shared. Wherever you make a loss, it is your loss. But when you make a profit, you have to give a share of that. As far as debt mutual funds are concerned, again they changed it. Previously, they allowed for indexation. Now they removed the indexation as per before. In 2023, they removed this indexation benefit. Now, indexation is no longer available for debt mutual funds. As far as equity types exchange traded funds are concerned, short term is 20% and long term is 12.5%. And gold ETFs are taxed as per your income tax if it is short term, less than 1 year, and it is more than 1 year, it is at a flat rate of 12.5% without indexation. This is how the changes have been made recently. As far as indexation is concerned, you go to the income tax website, government website, you have this calculator there, so you can put this and then see it. But what has happened is, with effective date from July 23, 2024, only what you have purchased before this, you can offset as a indexation cost. After this, anything that you have purchased after this, you are no longer having this benefit of indexation. That means you are likely to end up more tax for whatever real estate assets that you are going to create if you sell in future. So this is the new calculator that is there. It will ask whether the transfer was done on or after 23rd. So all those things will come into picture. If it is yes, then the calculated rate is different. So the cost of acquisition is 1 crore. then the indexed cost is 1,74,000 is the indexed cost. According to the calculation, that will be calculated by the income tax now. So these things you need to keep in mind whenever you are buying or selling your old assets also. So then there's something called as offsetting the loss in your whatever loss you have. So if you have made a net gain, then you also have a net loss, then you can subtract it against the short-term gain. Again, when you have a long-term gain, you can again offset it against a long-term loss. Suppose last year you had a loss, this year you had a profit. So the previous year's loss can be offset, and this can be carried forward for 5 years, provided you file your tax on time. If you don't pay your tax on time, then you cannot do this offsetting. So you need to be very clear that the tax filing has to be done on time. So you can ask your CA for all these things. So it will become too much for you people to understand so many things being told in this presentation. So to conclude, whatever we do, we'll have to pay tax to the government. Choose whether it's an old or a new tax regime, do a comparison, and then make the choice of paying or using the regime, which regime to use. Talk to your tax consultant, ask him to show a Excel sheet of the calculations, and cross-check it with in the income tax. There are a lot of good calculators that are there. So you go to the income tax website and use those calculators. It is very useful. So to conclude, a penny saved is a penny earned. That is what is more important, because whatever you save is already after you have paid the tax. So don't lose that, because if you lose that, then that is you're losing, including what you paid as a tax. Thank you. Thank you so much. Now, gold bond, the sovereign gold bond at maturity is not taxable. However, if you do it before, depending on how long you held, short term or long term, it will go through the same cycle. Short term will at 20% and long term at 12.5% without indexation benefit. Yeah.
If you are using it for the company purpose, then can we make it for the expenses, or can we claim the depreciation?
I think
or both the thing
both the things can be done. GST, you can input GST may not be available because you are not selling it again, but GST paid, you can ask your CA as to how you can use that, but you can show it as an asset and it can be under depreciation. You can use claim depreciation for that. So that's the difference.
Once you have shown the expenditure, how can you show it as an asset?
No, that's what you have to talk to the CA for that.
Okay.
Okay. You can do the insurance part, that is because an important